Okay, here we go. Let me share the screen and get these charts loaded. All right, sorry for the delay. Okay, so what we're going to do is take a look back at the first half of the week. So it's Wednesday, October 24th. We're going to take a look at the major pairs and then whether or not some of them have actually hit their targets based on these continuation breakout trades. So I'm going to start with I'll go ahead and start with the euro dollar. We talked about this yesterday. So I'm going to show you the setup, this particular technique. This is the continuation breakout trade. So right now it's about just a little bit after 6:30 New York time. And then in the members area, I'm going to post my analysis and the update for possible HL30s that could develop. Actually, we've got the rollover out of the way already at this point, so we've already set up our charts. I'll show you what that looks like on the 30-minute time frame, but I'm going to post that video in the members area. Right now, I'll walk you through the setup for the continuation breakout trade. So these are two totally different strategies. So for those of you who are new watching this for the first time, or you're not really too familiar of the strategies that I'm using, the HL30 is a technique that I developed, and I trade it on the 30-minute time frame. And I'm basically trading a bounce off of the previous day's high or low. With the continuation breakout trade, that is actually one of the first techniques that I developed. This was back in 2001 when I first started trading. And I'll walk you through the little bit of history and how I came about to develop the HL30 the continuation breakout trade, so you can understand the mechanics behind it. But that's what we're going to talk about here on this chart. This is the euro dollar. This is the 1 hour time frame. And I'm going to talk about the continuation breakout trade. So you can see, if you've been following along with some of my videos, you can see what's going on here. There's a range of consolidation. So I'll explain what the continuation breakout trade is. It's very different from the HL30. The continuation breakout trade is basically identifying a range of consolidation, which would require you to understand consolidation, how to quantify, qualify it, know the highs and the lows, what's appropriate, the appropriate ranges for that, because consolidation is subjective for the most part. I mean, you can get several different people identifying different highs and lows that they think are or would be significant as far as identifying a consolidation range. What would be the most appropriate level to identify, which could signal a possible breakout if a candle breaks out of that range. So I'm going to talk about a few different ranges in here and some levels that look good, but aren't always, in most cases, the best ranges to be trading off of. And then I'm also going to explain how I came about to develop this and what I was trying to avoid. So what you see here on the charts is the Bollinger Bands. That's primarily what stands out here in the price pane. And that's what I'm using. That's what I'm trying to gauge, whether I can confirm that a breakout is actually going to continue to trend in the direction of the breakout. And then, of course, I've got these two indicators down here, the CCI and then the MACD histogram. Now, I have not changed any of these indicators since I developed this method. One of the things that I needed to do before I developed this method, this was back in 2001, I needed to understand the mechanics and behind the indicators that I was using. I needed to understand why I was using a particular tool. So, for example, and you might be guilty of doing something like this now. I mean, I did this in the beginning of my trading career. When I first set up my first demo accounts and even my first live accounts, I just threw in whatever indicators just seemed to be, I guess, familiar to me in the way that I was reading a lot of information online, and what I was reading and the indicators that some of those articles or forums or threads and things like that were posting about, that's what I used. But I didn't spend enough time understanding the mechanics behind these indicators. Indicators are built to do different things. They're not all of them. They're not all going to do the same thing. So one of the things I learned from John Bollinger, and I mention this often, like, I'm a big fan of John Bollinger. I like the way he communicates his strategy and his analysis of price and the market and traders' reaction psychology behind it. I attended his 3-day workshop in Los Angeles many, many years ago, and I really like listening to him. What he says resonates with me, and it's very much the same way that I trade. Like I interpret that data and it makes a lot of sense when he says things. There's not a lot of resistance. Sometimes you might be following people, you might be watching their videos on YouTube, and even if they're making, really good money, they're doing really well, they've got a really solid trading system in place, you may not like them for some reason. It could just be that you just don't like the way they look, you don't like the way they talk, you don't like the way they present their information. So when I listened to John Bollinger, when I started listening to John Bollinger, nothing was, creating any resistance where I was ignoring anything that he said or having a hard time accepting what he said, because it really resonated with me. It wasn't just that, I stare at him and like him. That's not at all what it is. It's that what he says makes a lot of sense. As far as the market and the behavior and trader psychology and things, I understand it very, very well. It makes a lot of sense. So I was using his Bollinger Bands here when I first tried to develop some of my trading strategies. What I was doing was trying to trade breakouts and that squeeze play. And you can see them here. You can see a couple locations where they don't really create a head fake all that much, but it was hard for me because in the beginning of my trading career, I didn't have enough experience to know if I was using a particular tool or a system, or an indicator or something like that. I didn't know if I was using it correctly anyway. I was just putting it in places to see how it would react or how it looked. So I would customize a lot of the indicators. I would throw in a lot of different indicators. And sometimes I was getting multiple forms of the same type of confirmation. That's something that John Bollinger talked about. And it made a lot of sense to me when I heard him say it. He was talking about, be careful about using and selecting some of the indicators that you're using. You don't want to be using indicators that are doing the same thing, and then you think you're getting multiple forms of confirmation. You're just getting the same confirmation. You're getting double confirmation. So you want to be using indicators that do different things to give you multiple forms of confirmation of whatever the strategy is. So sometimes we're using strategies like the Tech 1 trade or the HL30, they're reversals. Other times I'm using these indicators to give me confirmation of a breakout and a trending move that develops after the breakout. So there are different reasons why I'm using different indicators. So going back to the squeeze play, I mean, you can see where it's coming together right here where my mouse is. There's a breakout and it moves up, but how far? Then you've got to put in place that even if you can identify some of the breakouts, where's your target, right? You've got to have a way or a system to determine where you should take profits and then where you should put your stop loss. So I'm sure all of you, if you're still experiencing this now, you know exactly what I'm talking about. When I would get into some of these trades, even when I was developing my system, I could get into a really good trade and it was working for me, but that was the first part, was trying to figure out where to get in and what to use for confirmation to even know I had a valid signal. And then once I had that valid signal and I could figure out where to get in, then I needed to start measuring how far I could expect price to move before I needed to lock in profits and take profits. And that really was all based on the timeframes I was using too. I needed to take all of this into consideration. So it was constant testing. Once I got to one stage, then it was the next problem or the next hurdle or the next issue. And then I had to test the second stage, and then I had to test the third stage. And I just kept testing all the way through. Unfortunately, I did it with my real live account. I don't recommend anybody doing anything like that. I recommend trying to stick it out with a demo account. But I did it with my real money, and I learned quickly to stop trading in a certain way that wasn't working. Very often there's a tendency to keep doing the same thing, hoping that you're going to get different results. And when you do that with your live account, right, you're going to blow up the account. I mean, that's when you start seeing the results and the effect. It's pretty dramatic. But we're going to go back to the setup here on this one. So I'm going to detach the charts. And this dotted line right here that you see right here, that separates the end of the previous week and the start of the new week. So we've got Friday close, and then the next candle is the first candle at the start of the new week. So I'm going to go back to the beginning of the week here. And you can see at one point when we had that low here on Friday, and then it moved up, that's one clean, clear, obvious price swing. There's no mistaking. I mean, there's one small negative candle in there, the opposite direction, but that's a clean price swing, and that's a clean move here. So when the market closes and it's the weekend and it looks like this is where I'm drawing and setting up my charts. I want to know where the weekly low is and the weekly high. Obviously at that point, it wasn't, price wasn't at a location when the market closed that I needed to worry about how prices was going to react off of support or resistance until it actually approaches that. At that point where it closed was about in the middle of the range, the trading range for the previous week, for last week. So here's how I set up my charts. And then I start looking for key resistance or support and resistance levels so that I can identify consolidation. Now, with the squeeze play, what was happening was, and John Bollinger talked about this, what he was talking about is sometimes when you get that squeeze play, first of all, you need to be using specific indicators anyway. Sometimes MetaTrader doesn't always give you the option to use those indicators. You might have to dig around to install them or use a more robust trading software chart package, something like eSignal, Fibonacci Trader charts. That's what I've been using in the past. And then there's TradingView now. There's a lot of them that you can pay for, and I would recommend paying for them. They're going to give you more information. Obviously, we can't see volume levels. I use, and it's extremely important for me to see volume levels. We talked about that the other day with the Japanese yen futures, and that was on Monday with the dollar yen. And it's important. I use that, and I can see, volume is an indicator. It's very important if you have the ability to see that, to be paying attention to it. Here, you don't see that, you can't. So I rely heavily on the behavior of the Bollinger Bands on the breakout. But back to what John Bollinger was saying is that sometimes you get a breakout on these squeeze plays and it can be a head fake, right? Just because it breaks out in one direction doesn't necessarily mean that it won't and can't turn around and go down the opposite direction. Now, it really didn't happen so far this week. Every time, you saw a little squeeze, the moves were pretty consistent. But what was happening was, and this is just at this point, right? Very often they will move up like this and then turn around and go the opposite direction. You can see them all over the place. And for example, you can look at this range right here, and then you need to be measuring the way the Bollinger Bands are constricting. You need to be measuring that. Again, using different indicators that you can't, obviously these indicators are not going to give me that information, but looking at price action itself and then looking for the breakouts, that's what I needed to do. I was more visual in the sense that I needed to box in the range of consolidation, not just look at these lines, these bands. It just wasn't providing the structure that me personally, the way I like to trade and the way I like to look at things, it wasn't providing me that, that structure that I like to see. So I use support and resistance, and I started incorporating support and resistance with specific price swings like this to identify highs and lows and then waiting for the breakouts. And I know that the Bollinger Bands and these indicators are going to be moving around all over the place. And I know that very often that there's going to be trades inside of this range. But in this case, in this situation, what I'm talking about is the breakout itself, the breakout technique, that strategy. If I'm just going to trade the continuation breakout trade and do nothing else, not trade reversals, not trade other candle patterns in here, and I'm not saying that there aren't, because there are other ways to trade the price action inside of these ranges of consolidation. But if I'm looking for the continuation breakout trade, then I would be doing nothing else but trying to identify the appropriate highs and lows of consolidation, boxing in that range of consolidation, and then waiting for the 1 hour candle to close outside of that range. So what would happen was when I started to piece together this strategy back in 2001, I started using it on a 30-minute chart. This is a 1 hour chart. I never used the continuation breakout trade on a time frame smaller than the 1 hour chart. I do not recommend using it on a 30-minute chart. I tried it when I developed it. So what would happen is if you look at this area right here where my cursor is, yeah, I don't want to use that example, but it would look something similar. What would happen in some situations, and I think this is a perfect example of that. So I would have a low and a high. You can see based on that price action, that structure, right? A clean price swing. There's no mistaking that this is a low and a high right there, and then everything sort of goes sideways. And then we get, start of the new week. And the week and the rollover like this doesn't necessarily mean that it has to be in place in order to confirm this. It just happened to set up that way. Well, what would happen was if this was a 30-minute chart, for example, and then the 30-minute candle, let's say that the 10 to 10:30 candle, closes at 10:30, it would close above that resistance point. And I thought that was my signal. So then if price moved up, I would get in going long, and then it would turn around and roll right back down inside a consolidation. So I did that for a while on a 30-minute chart, and then I wondered what would happen if I tested it on a 1-hour chart. So I ran it through a 1-hour chart. I would role play, from the start of the week to the end of the week, one candle at a time. I switched it to a 1-hour time frame, and I realized that this is exactly what would happen. Very often when I got a candle that closed on the 1-hour time frame, I needed to look at the indicators to confirm, and I'll talk about that in a minute. And if it didn't confirm, then I never went long, and then I stayed out of it. It kept me out of, and it eliminated most of my head fake trades that I would get into, most of the trades that were head fakes. It eliminated that just by using the 1-hour time frame. The 1-hour time frame is a very significant time frame for day trading. Some people will argue, and I'm not saying that you can only trade on the 1-hour time frame. I'm not saying that you can't trade on a 15-minute. But for this technique, the way I trade it with these indicators and the confirmation and what I'm looking for, the 1-hour time frame is appropriate, and it's important that you use it for day trading purposes, using the stop loss and the take profit levels that I'm using for this particular strategy. Again, I'm not saying that the 1-hour time frame is the only time frame to trade off of for day trading. I'm not saying that. I sort of not defend, but need to be really clear about what I'm talking about. How I'm not saying that the 1-hour time frame is the only time frame to trade for day trading. I'm not saying that. The reason I bring that up is because sometimes it can be, there can be a little bit of resistance if you think I might be leading or saying something that doesn't make any sense. Obviously, I've been trading since 2001, so I know that doesn't make any sense, first of all. But when I started to post my ideas on Forex Factory, there were a lot of people that were jumping in on my thread saying, this guy's a total liar. You can't trade on a 1-hour time frame. And I'm thinking, how can you even say that? Like, there's so many different ways to trade, so many different time frames, so many different strategies, so many different ways to look at it. How can you say that? So again, I'm very, very careful about knowing and admitting that this technique and this way that I trade it isn't the only way to do it. It's just the way that I do it. It's the way that makes sense. I combined these indicators so that they made sense to me, and I created a system out of it that works. Now, one of the reasons, and I talked about, if I was only trading the continuation breakout trade exclusively, if that's the only thing I was doing, then one of the things that I'm going to be looking for, or let's say if I was only going to be trading the breakouts, one of the reasons why I would do that is that this particular technique is accurate 90 to 95% of the time. As long as I use it correctly, as long as I'm very, very disciplined in my execution and making sure that, you know how sometimes you look at a trade and you see the setup and you look at the indicators if you're using any to confirm your trade, and you sit back for a moment and you think, well, it looks like it, but then it kind of looks off. It doesn't look like it's really lining up correctly for me. When you think that, and then you get into the trade and you see that the trade fails. So that's what I'm talking about, using that extreme discipline that will keep you out of taking those trades where you're thinking to yourself, well, it might work, and then again, it might not work. So I'm going to go ahead and try it. That kind of thinking is where you increase, the chances of it being more like a gambling type of risk, and you can't control what's going on. The only thing that you can control is your execution and your behavior and the way you analyze it. And that's why it's so important to have it, your trading system and the techniques that you use structured. They have to be very, very structured. The other thing is, I won't get into a trade, even if I can see the setup, even if I can tell where it's likely to move to. If I don't have a target and I can't really predict how far the retracement, things like that are going to go, and I can't use a stop loss that I'm comfortable with, then I'm just going to pass on the trade. Now, I know that sounds really easy to do or say, but it's not that easy to do, right? In the heat of the moment, sometimes if you've gone 2 or 3 trading sessions, or even, I mean, I do it sometimes. I see the charts and maybe I'm out sick for the day, and then I can see I missed a big day. And then you sit back at your desk and you're looking for a trade the next day, and you want something, right? You want to take, you know what you missed, so you want to try to take some of the price action that's available. It doesn't work like that. Like, you can't force a trade where it doesn't belong. Just because you want to trade when you're sitting down at your desk doesn't mean that the market's going to give you a trade. You have to learn that whatever techniques and strategies you're using, if it's not available, the setups aren't available, get up and walk away. I know it's hard, and it's easy to say, but it's very, very hard to do. Sometimes you've got to close the entire trading platform, maybe even turn off your computer and walk away. I had to do that in the beginning until I got used to that idea where it was better off for me to just walk away. So back to the continuation breakout trade. One of the other things, though, that I want to talk about is that this range right here, when I talk about consolidation, this is a range of consolidation right here. You can see there's about 10, 12 candles right here. That's at least a trading session, right? About that amount of time. And it would be very, very easy to say, okay, well, there's a high and there's a low right there. Why couldn't this be a continuation breakout trade? And even though this sort of looks like it right there and it starts to move and behave that way, the ranges from the high to the low that I'm using for consolidation have to be a specific distance. If it's too small, very often what will happen is a candle will close outside of that range and then again come right back down inside of consolidation. Now, in this instance, it didn't really do that, but it can and it very often does, and you got to be aware of that. Just because it doesn't do it this time and you think, okay, well, you know, I'm just going to break the rules because I saw it work one time. So I'm going to try it. Maybe the next time it'll be okay. And then that's the next time. And the next time after that you try it, that it continues to fail on you. You've got to stick to the rules as hard as it is. You really have to stick to the rules. I mean, it's easy to break these rules. So if we were to look at the high right there of that candle, that's 1.1468. The low is 1.1432. That's not very wide. I mean, that's if anything like 40, 50, maybe even 60 pips from the high to the low of consolidation, that is, in my opinion, pretty tight. And I can show you time after time after time of doing, I do this in one exercise called the closed market analysis exercise. So when people join into my trading course and they look at the continuation breakout trade, there's an exercise that you do that will teach you how to identify the breakouts and measure the highs and the lows of consolidation. And very often when you do that exercise, you're going to see that pattern where if the high and the low of consolidation is too small, then it could lead to the head fake and it'll turn around and come right back down. So you start to increase the number of losing trades for the continuation breakout trade. So when I say that it's accurate 90 to 95% of the time, these are some of the things that I need to take into consideration, one of which needs to be the distance of consolidation has to be a minimum of 65, 70 pips. Even 100 pips is okay, but this is obvious. This is a very clean, obvious price swing. So Friday, when the market closes right there, that's my high. You know, that's a clean, I'm going to start using that to identify a possible continuation breakout trade. I'm going to go ahead and go to that candle that I already showed you a moment ago that we talked about. And this is the signal candle for the continuation breakout trade. First of all, the distance from the high to that low is appropriate for the continuation breakout trade. I'm using the 1 hour time frame. I need to look at the Bollinger Bands first for confirmation on the close and completed candle above that resistance point. Something I want to share with you, back in 2001, as I was piecing together some of these trading strategies, and one of the things that really encouraged me to do it even more was that I was joining chat rooms, and just like everybody else, and the chat rooms, they would have moderators that would call out trades. And a lot of them just weren't qualified to be trading. I mean, this is how it worked. So I purchased a $2,000 trading course online. I was talking to the company. They're down in Florida. They're still around, the company. Matter of fact, I still see his son running YouTube ads. Anyway, they charge a lot of money. And I've had a lot of my students go through their program and spend a 3-day weekend, Friday, Saturday, and Sunday, and they pay about $5,000 for this course. And when they're done with the course, they usually come back out thinking, okay, well, I learned a lot, but I still don't know precisely when to get in, when to get out, that kind of thing. And that's what I was looking for too. Back in 2001, I bought their trading course. This is before they actually had they might have had, you know, where you could come in and sit down on the, you know, in their location. They're in Florida, but I'm in California, so I wasn't going to travel all the way over there anyway. It was a $2,000 course with 17 CDs and 17 manuals. I went through all the material. I received the package on Friday, and I was done by Sunday when the market opened for trading for me. And I still didn't know when to get in, when to get out. It was just all basic textbook knowledge. That company that sold me that $2,000 trading course also sold me an upgrade and told me that for $149, just about $150 with some change, for $150 a month, I could join their chat room and that they would be calling out trades for me. So the people that were in there, in the chat room moderators, they were students that had purchased the same trading course. So they were calling out trades in the chat room, supposedly using some of these strategies, but they were all textbook stuff. I mean, it was just really weird. They would call out trades, and then disappear for a while. They wouldn't always tell us where the take profit levels were, and they wouldn't tell us where to place our stops, because we were supposedly we should have already had that information in the trading course. But sometimes they would say, okay, well, if you take a breakout like this, you got to take a look at the last price swing low and maybe put your stop 15 to 20 pips below that low. But really, there's a price swing here, so really it needs to be below the overall low. They would say things like that, and some people, that's a big distance. There's 100 pips in there, and some people would use like a 40, 50 pip stop. They'd get stopped out, and then they would say sometimes it's not big enough or whatever. They weren't very clear on it. Anyway, what consistently happened is we would see a range like this. And when price would take out, let's say, a price swing high like this one, just the way I've drawn it here, the chat room moderator would scream, buy euro dollar in the chat room, and we would all buy euro dollar. And we all got in at different prices because he was never really specific. He didn't tell us prior to it happening, if it goes through, I'm going to buy it at a certain level. That's kind of hard to do, right? Especially if you don't even know yet if it's going to clear that level. And so you can see the difference here in this one candle. Price is sitting right down here, quite a distance away from that high. And then all of a sudden in that 1 hour candle, it starts to really pick up momentum. So then you start thinking, and it's easy to think that when this candle's open, that even if it closes towards the highs, the next candle should continue. And that was one of the things that you could tell these chat room moderators were hoping for, is that price was going to continue. And it didn't. It would roll over just like this and we'd all get stopped out. And then everybody would ask, why did that trade fail? And they never had an answer. So that's what I was trying to avoid. I was also trying to avoid getting into these head fakes like this. And one of the things that I did was, here's my signal candle for the continuation breakout trade. This is my consolidation range. It is appropriate as far as the high and the low, the distance. And then I go to the Bollinger Bands first. And the Bollinger Bands, again, I don't have futures volume and things like that here available to me on this platform. So I've got to look at the Bollinger Bands. And on this breakout trade, if it is going to continue and trend in the direction of the breakout, that's going to be a pretty significant move. And it's got to have some volume behind it. These Bollinger Bands should be separating away from each other on the closed completed candle there. That's something else that I learned and I put together on my own, was that regardless of whatever time frame I'm looking at, I cannot analyze this chart and this possible trade opportunity until that candle closes. That's also what helped me stay away from some of these head fakes, because as these chat room moderators, as I described, would call out trades just because price was taking out the high of, a price swing high, if they would have waited for the candle to close, because very often it'll pull right back down and stay inside a consolidation, right? You get all that action during that live candle and everybody thinks this is it. And then all of a sudden the whole thing collapses and it turns around and comes back down. Just by waiting for the candle to close itself helps me analyze a candle that's just got more importance behind it. I mean, it's solidified at that point that this is either a breakout or it's not trying to trade it while it's open. I realized that also when I was trading back in 2001. I would take a look at the end of the week, through the weekends. I would analyze my trades, and I would say, if I was just trading the way or with the same information that I have when the market's closed, right? When the market's closed, you roll the charts around like this, and all you see are closed completed candles. You don't see, and you're not tempted by the price action, a live candle. And if I just traded as if I was looking at and analyzing closed completed candles, that also eliminated most of my failed trades as well. So that's a tip that you can use, and you can apply that to any time frame, any strategy that you're using. Sometimes it's a good idea to wait for that candle to close, depending on the strategy, of course. But there's other strategies that might require you to take that. I've got a T3 pattern that would put me into the trade as it's taking out the high, but it's not like the continuation breakout trade. It's something totally different. So in this case, the Bollinger Bands, since they're not separating away from each other, showing me the sign of strength because they're sort of moving in the same direction, that's divergence to me, at least for the Bollinger Bands. And this would indicate to me that price is probably going to turn around and come right back down. So while this is a confirmed closed completed continuation breakout signal candle, as far as the confirmation with it being closed, the Bollinger Bands are not giving me the confirmation that I need. That's the first indicator that I look at. And then I look at the CCI. There cannot be any divergence. And then I look at the MACD histogram. So this trade would fail, in my opinion, anyway, even if I get the entry. And then you can see what happened here. And then later on in the week, we were talking about, okay, now I have another significant, important, in my opinion, resistance point, which is this week's high. So you can see how I have to make adjustments to it. Sometimes temporarily a high will be the high point for my consolidation, and then something will happen just like this, and then I just follow along. I need to make an adjustment to that resistance point and then wait for the next opportunity. Now, I'm not saying that there's no trade here and you can't sell it. You can. This would be like a Tech 1 trade or a T2 pattern. These are strategies that I developed, but I'm not talking about that. I'm just talking about the continuation breakout trades. And again, the continuation breakout trades, that technique, that one strategy is more accurate and more profitable to me than any other technique that I use. And it's because I get so many different opportunities to look for this one specific moment when I know that when I get a breakout, it's going to keep on moving. It's going to move in my favor. So then at that point, and this was just the other day, and I believe we were talking about this yesterday too, we have this week's high, and then we have last week's low. These are pretty significant locations for me, in my opinion, and I think they are for most people, especially if they're intraday trading. And at this point, it's just a matter of waiting for another breakout. And then, you never know. The next time it breaks out, it doesn't necessarily mean just because it's a second or the third breakout candle that it's going to work. You have to wait until it happens, and then, again, look at the indicators, and then wait for confirmation, and then wait for the entry. So this took a while. There's the continuation breakout trade to the downside. Right here. I'm kind of giving the future away here, what I'm going to explain. So there's also something else that I want to share with you is that even if this candle closes and it gives me confirmation, that's not the entry. I still need something else to happen for the actual entry. That is also what keeps me out of getting into a head fake. I'll explain that in just a moment. So this is another continuation breakout trade. And in this situation, you can see that on that candle, both of the Bollinger Bands are separating away from each other on the closed completed 1 hour candle below last week's low. And then I go to the CCI, there's no divergence, and then you can see the MACD following in the same direction. So out of all three of these indicators, they're all confirming for me. This is a confirmed continuation breakout trade. That's not the entry, that's just the signal. Now, I have to wait for price to take out that low by 3 pips. I call that the 3 pip entry. Very often what you'll see, and it's not in this case because this was a good clean trade, but very often what will happen if this is going to be a head fake is that candle will close and look just like this, but the next candle won't move lower than 3 pips below the signal candle low. It'll stay maybe equal, maybe 1 or 2 pips lower, and then turn around and go right back up. And that would be a head fake move. The 3 pip entry keeps me out of trouble every single time I use it correctly. I have example after example after example from 2001 when I developed it all the way to today where so there you can see that I'm doing several different things at different stages at support and resistance to help me stay out of these head fake moves. That was the thing that was really disturbing to me when I was trading in a lot of these different chat rooms, when these chat room moderators would call out buy or sell just because price was taking out a high or a low, is that we would get stuck in these head fake moves. It was just so irritating. Like, how do you figure that out? How do you know that it's likely to become a head fake? And it bothered me so much, and I lost so much money because of it, that I spent a lot of time trying to figure out ways to signal to me, to give me a clue that it might be a head fake and I need to stay away from it. I need to stay out of the trade altogether. So if price takes out the low by 3 pips, the low right there is 1.1422. So we've got an entry at 19. And then we use a 55 pip stop and a 55 pip take profit. So this is what happened afterwards. And here we are sort of moving sideways. And it has not hit the final target here at 64, but it'll probably make one more move again to the downside. And I would not be trading a bounce on this pair right now. it'll probably move up a little bit higher and then pull right back down again to the 64. So 1.1364. Now, in a situation like this where price starts to take a little bit longer, the other thing that I want to mention is that, and I'm not going to switch to a 4-hour or a daily time frame, but when this signal candle develops, I also want to take a quick look at the 4-hour time frame and the daily time frame. And one of the reasons, is this. Eventually, one of these continuation breakout trades will fail, meaning that it might move and it might pay, but it might not hit the 55 pip take profit level. And one of the reasons why that could happen is that this continuation breakout trade to the downside may not be the first one. There may have been multiple continuation breakout trades all the way back here, and it could have been a trend that was in place for quite some time. And you may not be able to see that because you're just trading off of a 1-hour time frame. So what could happen is on a daily or 4-hour chart, let's say a daily, this could be a significant support level or an extension target or something like that on a daily time frame on a bigger overall move. And here is where it's going to stop. And you may not be able to see that because you're just trading with this myopic point of view, just looking at this little tiny space in time and not stepping back and looking at the overall larger picture. So in a situation like that, where if you can see that it's approaching a major support level on the 4-hour or daily chart, but you want to trade this and everything looks perfect on this continuation breakout trade, you need to be more cautious as it's approaching a major support level if you're going to sell it than if it was the first continuation breakout trade in this new downward downtrend. So you have to be looking at the 4-hour and the daily chart quickly when you see this setup, just to give it one more last look to make sure that it's got that room and that potential. And you also want to ask yourself, is this the first continuation breakout trade to the downside, or have there been several others all the way back up here? There have been several others since last week, continuation breakout trades. So it's possible that this is nearing a major support level. So again, in a situation like that, when you get into a trade like this and it starts to stall, well, then I'm going to scale out. 55 pips is the target, and it will almost always hit that target if everything is optimum, the conditions are optimum, including what I just described, that this isn't one of the last continuation breakout trades in the end of a move, at the end of a trend. So if it is, and it's approaching a major support or resistance, depending on the direction that we're trading it in, scale out. And you would get in at the appropriate 3-pip entry, but based on the 3-pip entry, you would take profits at the first 20 to 25 pips. So you would already lock in some profits here. If you can scale out of the trade, you would lock in profits and then set the second half of your position at a break-even stop. If it goes back up and stops you out, then at least you protected the first 20 to 25 pips. If it doesn't go back out and stop you out, the second half just drops right back down and tests that 1.1364. That is the final target. But again, we are nearing, and it has been a trend, a downtrend that's been in place for quite some time. There have been several continuation breakout trades to the downside. So we have to be careful. Let me show you another example. I'm going to go ahead and do that. And we're going to go here. Another example, continuation breakout trade. This is the pound dollar. So the pound dollar at pretty much the same time that the euro dollar set up last night, same time, we got a continuation breakout trade. There was the entry at 1.2923, 55 pip stop, 55 pip take profit level. There's the 55 pip take profit level, 1.2868. Sometimes one currency pair will move a little bit further, depending on how much pressure there is, how much pressure to the downside, what's the sentiment, what's the news, we've got Brexit talks all the time. Every morning I wake up to see new updates on it, and it can set the stage for the day. But you can see again, we've got multiple continuation breakout trades that have happened, and it's been in a downtrend for a little while, and it's possible, again, you got to be really careful, but it's possible that it could be approaching a major significant support level that you wouldn't be able to see here on the 1-hour time frame. You've got to go to a 4-hour and daily chart to take a look at that. At this point, I wouldn't necessarily trade a bounce just yet. It has hit that final target, but I would still expect that it could move down one more time. Even if it does move down one more time, it still may need to move up one more time first. That's also a possibility. Now, something else I want to say is that if the trend continues and you get a continuation breakout trade, it's possible that it could go further than the 55 pip take profit level. So let me explain why it's 55 pips. So earlier I talked about the setup and how I tested it and how I went from one stage to the next, to the next, to the next, all the way until I had a completed strategy. It was time consuming. It was very scientific in the way that I analyzed the data. I didn't really know necessarily that I was doing the right thing. I just had to keep going with my beliefs and what I was seeing, and the fact that it was giving me signals that were positive where I could see the potential to make money, but I needed to know where to take profits. I needed to know where to put my stop loss. Just like with the continuation breakout trade, I also needed to know where my entry was. When I first figured out that 3 pip entry, when I got the signal, I started using a 10 pip entry. But the 10 pip entry was eating into too much of my profits. So then I switched to a 7, then I switched to a 5, and then I realized 3, and then I stuck on the 3, and it held me into all of the trades, no matter what. After all of these years, I kept testing it. That was the only way for me to figure it out. I didn't do back testing. I looked at back testing, of course, to make sure, just to prove it to myself, but then it needed to be used in a live trading environment, because that was the final test, was being able to execute. Because I can do back testing all I want, but in a live trade, at that live, the heat of the moment, you've got to be able to execute and to know what it is that you're looking at, that you believe it, you know it, you see it. There's no confusing what you see. It's just a matter of then controlling your behavior and executing correctly. So the distance. Now, when I got into the continuation breakout trade, this is the first stage, right? I figured out where my entries were. Sometimes I'd be up 40 pips on a breakout trade, and I think, wow, this is really working. And then I would think, I wonder if I can get 50 pips. And this is with live trades. So I have to tell you that that's how I did it, because by telling you that, at least you can understand some of my motivation and how it stung, and how this is why I stuck with it. If it was a demo account, maybe I wouldn't have been so, adamant about trying to figure out like all of these little details. And like, I couldn't sleep when there was something that was bothering me, or something I did wrong, or something I needed to figure out. I would look for another opportunity to try to figure that next stage out. It was just, I couldn't let go of it. It consumed everything. I would dream of these trades just like this. And then I would sometimes wake up with these ideas to try to figure it out. And I'd go back in and sort of, again, role play, move around, one candle at a time, all that stuff. And it started to work. It was really everything that was put into these strategies and these techniques to figure it out. But again, once I got into the trade, I would say, okay, well, 50 pips would be nice. Let's see if we can get 50. And then sometimes it would give me 50. And then sometimes it would even give me 60. And then sometimes it would go to 70 or even 80 pips on a certain day. Maybe economic data would happen after I got into the trade. And then I still wouldn't take profits, because I didn't really know where to take profits. I mean, I understood daily average trading ranges and things like that. But when you're up a lot of money like that, and you're trying to figure out how far something could go or whatever, you're just trying to test things like that. You sort of leave it alone and see what happens next. And then the whole trade would roll over, and then it would turn into a losing trade. And, I would give up all those profits. So then I had to go back in and test it and see, from the point in time where I got the actual confirmed signal candle, how far could I expect price to normally go? And I was able to, at first, figure that out based on daily average trading ranges. So back in 2001, I started looking for daily average trading ranges, and there were a few. I mean, there were some comments about it, and there was people talking about it on forums, but there were only very few, and it was hard to find websites where they had spreadsheets on the daily average trading ranges for the euro dollar and the pound dollar. So I had to sort of incorporate that data into how far I could expect. So I started picking some of these numbers and looking and measuring the distance, and 55 pips. Again, if everything and the conditions are optimum, you're paying attention to the trend, you're making sure you're not running into a major support level, all of the indicators are confirming, you get in with the 3 pip entry, 55 pips is where it hits almost every single time, 90 to 95% of the time, as long as you do it right. All the indicators have to line up. Everything has to be perfect. Sometimes it'll go a little bit further, and sometimes it'll stop just like this at that 55 pip, or maybe 2 or 3 pips below it. And that's it. That's all it gives you. And this happens all of the time. When it does fall, when it goes to maybe a pip or two away from it, it looks really dramatic. It's like, wow, how did you pick that bottom like that? And again, it's not so much that, I'm no genius at all. It's just that I measured the distance, and then I've been testing it for the last 17 and a half, 18 years. That's testing it, meaning that I'm trading it live. I know that it works. And I know that it works in all of these conditions. Global financial meltdown, I use the same strategy. Every meltdown, every crisis, all the time. When consolidation is in place, it's because the market doesn't have enough information to decide to either they're either in their trade or they're waiting to make a decision. And very often these breakouts will develop with maybe political statements, more information, economic data, whatever the event is, whatever it's causing the consolidation. Then at that point, there's more clarity. The other thing to take into consideration is the time frame that some of these, the actual timing of these trades and these signals very often will happen during a trading session that's a little more active, right? London session, New York session, things like that. So be aware of that as well. So when it hits the 55 pip take profit, sometimes it'll go like to maybe another 20, 30 pips lower. And that's okay. You still have to follow the plan and take profits at that 55, because if you think it's going to go further because it did the previous trade and you're thinking, well, I'm not going to take 55. It went down like 80 pips. I'm going to take 80. And then the next time it doesn't do that. Next time it stalls and hits, goes just 2 pips lower than that 55, and then it rolls right back up again. It happens sometimes. And that is the reason why, again, we're taking into consideration how far can you really expect the pound dollar to move in a single day based on the available information at that time, right? What kind of news was available? What kind of news caused this? What kind of news was in place before? I mean, what's causing the daily time frame patterns, that kind of thing. You've got to look at that, and you've got to be willing to take profits. This is what we're here to do, is here to look for trades, find the best opportunity according to the way we trade and our technique, make sure we're confirming, control our behavior, and we're here to make profits. We're here to take profits. You've got to take profits at specific locations to get paid. I mean, that's what we're doing. And that's one of the reasons why I use the 1 hour time frame is for day trading. Usually I'm in and out of these trades within the chain, within the same trading session. Sometimes it'll roll over, right? Sometimes it'll take 10, 12, 13 hours, 14 hours. I can't control that. But the structure of the trade is still intact. Everything is still okay. So that's pretty much all I want to talk about there. The dollar yen is a bit choppy. Just coming back and testing this trend line that you see right here. This is a dollar yen. I'm not going to talk about the Japanese yen futures. We're going to talk about that, and I'm going to post that video in the excuse me, members section later on this evening. But again, this is the 1 hour time frame. Excuse me, I'm going to get a drink of water real quick. But for the most part, the dollar yen is inside of consolidation. You know, you can see a few little breakouts, but again, consolidation is what? That's another thing I want to point out, is that the number of candles will also help me determine the consolidation that's appropriate for me to trade the continuation breakout trade. Remember, this is how I use it. This is not how all trading strategies work with consolidation. I'm not saying that at all. What I'm saying is I took something that was very, very confusing and odd and very subjective. Everybody's got a different opinion, and I had to figure it out and put it into a place and in a way that made sense to me. So again, when I'm saying some of these things, that's not necessarily the market rule. It's just that that's what works for the way that I get into these trades and where I take profits and the indicators that I use and the confirmation that I need, all of that. That's what I figured out. And it took me a really long time. It's very hard to develop your own trading strategies. Even the HL30, as simple as it is, that took me a long time of sitting there watching how price acts after the rollover period, the 5 o'clock rollover at New York time. I was sitting there looking at charts and I was thinking, there's got to be another way to trade, you know, when it's quiet and it's flat and it's slow, or get into a trade where you see a signal, even if it takes 8 hours for it to actually start to pick up momentum and then move to that target. But there's got to be ways. And sometimes there is, sometimes there isn't. It really depends. Sometimes there are no HL30s after the rollover. Just because you're looking for it doesn't mean you're going to find it. You've got to wait for the market to give it to you. And you've got to be patient enough and disciplined enough to not let yourself get confused and tempted with some of the movement that isn't something that you understand. So like I've said before, very often I can tell where price is likely to move to, but if I don't have a precise entry and I can't figure out the targets, then I'm just going to let it go. And I would much rather pass on some of these more risky trades and let price move, even though a lot of movement and a lot of price action has taken place. sometimes I get emails and they'll say, why aren't you trading this? Well, if it's stuck in the middle of a range that's confusing to me and I see divergence and I think that it's a higher risk trade for me, then I'm going to wait for a trade that's not as high a risk, which would be waiting for price to approach support or resistance, right? And then watching how the market reacts to it and trying to trade either a breakout or a reversal. That's why the continuation breakout trade is so reliable to me. I wait until price approaches support or resistance and then see how the market and price behaves at those levels. Everybody's looking at those support and resistance levels. Everybody is. We all see it. Everybody knew where last week's low was if they were trading it this week, especially on a 1 hour time frame or even 30-minute. They should know where last week's low was. And then we see the retest and then we see it again and it breaks out. So again, I'm waiting for the reaction. I'm waiting for price to approach either support or resistance. And you'll notice that when it's sort of in the middle of this consolidation range in here, I'm not going to do anything. This is not a good optimum environment to trade the HL30. And it's really not an opportunity to trade a Tech 1 trade, which would be a bounce off of support and resistance inside of a range like this. So for the most part, for hours, I'm not doing anything. I'm not going to trade anything. It's not giving me a signal. I see some of the patterns, but you can try and trade some of these bearish candle patterns, and they, unless you're scalping, if you think that it's going to go down and take out that low just because you see that engulfing bearish candle, well, how many times do we see it turn around and go right back up again? And then your stop loss has an impact on the trade, right? If you're using a really small stop loss, it might stop you out prematurely, and then it turns around later on, and then it goes down. All of these things come into play. So it's better to just stay away from it. If I see that it's likely to make a bigger retracement, even though I can pick the direction, but I'm not willing to use a larger stop loss, then just wait. Then wait for it to actually bounce off of support or resistance or break out of that support or resistance. And then at the same time, again, you can look at the news. There was news. This is a euro dollar that helped set this up. So that's the continuation breakout trade. That's where I'm going to leave it here. As far as what we're going to do next, again, I would expect that price is probably going to continue down here and retest that low. But again, pay attention to the larger time frames, 4 hour, daily time frame. This would be one of those situations where if you were trading a continuation breakout trade, scaling out would be a very smart thing to do. So going back to the dollar yen, I'm going to make some adjustments, right? I want to take into consideration this week's high. This is the dotted line starting off my new week. And then I've got last week's low. And here, excuse me, this trend line right here, that's pulled in from the daily time frame, and it has bounced on the daily time frame, the dollar yen, several different times. And it's held so far. So who knows? Again, it might eventually break. I use Japanese futures to give me sort of an additional form of confirmation, mainly because I can see volume when I'm doing that. And I'm using that to help me find direction and trade with more consistency, at least my expectations on breakouts with the dollar yen. Now, something else I want to bring to your attention, when these signal candles here, the continuation breakout trade on the euro dollar and the pound dollar, when the euro dollar here, this set up at the same time, if you look at the dollar 1 hour time frame, the dollar index, if you look at the dollar 1 hour time frame, I do the same thing and I set up my charts just like this. I'm looking for continuation breakout trades on the dollar. Even if I'm not trading it, I'm going to use it as confirmation. And we had continuation breakout trade, a continuation breakout trade at the same time that this developed on the US dollar to the upside, and it moved, and that helps with confirmation as well. You want to be aware. Now, sometimes the dollar isn't going to do anything. Sometimes the dollar is going to move flat, but then you get activity here in the euro dollar, but then the pound dollar is moving flat too. So you can sort of see where I'm going with all this. Every one of these currencies is its own independent economy for the most part, but then again, everything is tied together too on a global basis. So it could be that one currency pair is moving at that moment temporarily based on something that's happening or having an impact on that particular currency pair, but it's not really affecting anything else. So you have to be aware of that too. So look for multiple forms of confirmation there. Keep an eye on the dollar. Be aware of that. So I'm going to stop here, and then as I mentioned, I'll be uploading in the members area the HL30, and then the other opportunities there. And we'll take a look at I guess the dollar. I'll point out the dollar as well there. So Yeah, I think that's about it here. Okay, so I'm going to finish here. And then, so these updates, actually, this is the start of many of our YouTube lives. I'll be doing updates at 9:15 Pacific time, 5 days a week, which is actually 12:15 Eastern time or New York time. If we have been in trades with the trade copier at that time, I'll talk about them and I'll explain them. And if not, let's say it's just inside of consolidation, I'll explain why I haven't executed trades and then what I'm looking for.